Alrighty, we are live and direct together in person.
Again,
Finally. Together at last, as I like to say. Hello. It is the STR Data Lab brought to you by Airbnb. I am Mariah Kamei, VP of Marketing. And of course, I am just here to play sidekick to the Maestro, VP of Research, Jamie Lane. Jamie, hi. The holidays are upon us.
yeah.
And I think you brought me a gift today. And I think you also brought our listeners and viewers a gift as well. And that is our highly anticipated end of the year outlook report for 2023, folks. Today, we are going to talk about what we are predicting, some predictions, forecasts, and expectations for the coming year in our industry. And that said, the outlook report, of course, is a gift to all of us. However, we're not going to sugarcoat it. There's a lot of, I will say, trepidation around what is going to happen next year in the economy, in lots of different areas, in particular in our little neck of the woods, short-term rentals. So Jamie, let's just dig into it. Let's get into the details here, my friend. Of course, I'm sure a lot of folks are wondering what that means for things like their revenue and their livelihood. Let's talk about it.
Yeah, so we put out this regular outlook report where we actually try to put out a industry forecast, and there's really no getting around that the forecast for next year is negative. We've had a few years, 3 years now, of positive results, really record years for the short-term rental industry. And at least on a revenue per available listing, we have revenue going down next year. So that is a bit concerning, though. And if you look at it relative to where we were at in 2019, where we were at prior years, and this is still, I like to call it persistence at the peak.
Okay.
So we're at the top. We're maintaining really high levels of revenues. And yes, we do have occupancies declining. We had it this year. We expect it to further decline next year. ADRs are not going to sort of outpace the decline in occupancy like we saw in 2022. And a part of that is math. We've had really high.
My favorite, math.
We've had really high inflation this year,
right,
which nominally means that rate growth has been really high. Though, if you sort of control for how high inflation's been, costs going up, and we have had a real decline in rates this year. We expect similar levels next year, though we don't expect inflation to be as high. So that means sort of lower nominal rates. So we're expecting about 1.5% rate growth next year.
Gotcha. So not quite that crazy rocket ship that everyone was on from 2020 to 2021, 22. Still, I love this. Am I going to say it right? The peak.
Persistence at the
peak. One, it's an alliteration, which I love.
Yeah.
And two, it sounds good. And ADR, for everyone, just in case you're wondering, is average daily rate. Okay, so that sort of is, not completely. I mean, we're not going necessarily into negative. We're just seeing the growth slow.
Revenue is going negative.
Okay.
Yeah, but demand is still going to be positive. So we expect another record year for people staying in short-term rentals next year. The growth of demand is not going to be as strong. So in 2022, we saw about 20% demand growth. Next year, we're expecting about 6%. So that is a significant slowing.
Yeah.
And I think many people out there are expecting a recession. And broadly, and there's a very high likelihood of a recession next year. We subscribe to Oxford Economics. We get their forecasts.
Right.
That's the economic scenarios that sort of go into our thinking. And in Oxford's baseline scenario, they are anticipating a mild recession about in the mid part of 2023. So that is playing into the figures and is a lot of the reason why demand growth is so weak. Uh,
Got it.
so why isn't going negative? That's a
Yeah.
question I
Yeah.
get
Yeah.
pretty often.
Right. Right. We all have different. What I love about the Oxford is it's like some of you are probably worst case people, some of you are best case, and then
Yeah.
there's the people in the middle. And I love that it's kind of, we're able to sort of look at it in those three different lenses.
Yeah, and what Mariah was talking about, and you'll see in the Outlook report, is we do have a variety of scenarios.
Yes.
So we've got an upside scenario.
It's like game theory.
Yeah,
We're playing. What could happen?
I like to, choose your own adventure.
Yes, exactly.
So if you sort of don't buy into we're going to recession next year, you're like,
Right.
and we're gonna have a soft landing. The Fed's gonna and masterfully control the economy and not push us into recession.
Yeah, that's what
we've got a scenario for you.
Yes, exactly.
And if you think that the Fed's going to severely over tighten, push the economy into a deeper recession, where we're going to see significant job loss, unemployment go up, we've got that scenario. Yeah, but so we'll focus on our baseline scenario.
I like a baseline, and that's the middle one. That's the one that's sort of evening those two out.
Yeah. So we do have a recession, but we do expect the sort of tailwinds for the travel and hospitality sector to outweigh any headwinds, be it mild headwinds in the overall economy. This could be one of the first recessions, at least in near-term memory, where we don't see significant job loss associated with that recession. And I think most importantly, we don't see any factors outwardly impacting travel. Where I think it was in our first podcast, we sort of talked through like the great financial crisis, 9/11, COVID, all impacted the travel and tourism industry way more than the broader economy. This one, we actually expect the broader economy to be hurt more than the travel sector, broadly the service sector. And many economists are saying that this could be called a goods recession. So, yeah, we're sort of pulling back on spending on things, spending more on travel. There's been so much pent up demand. There's maybe fewer Amazon boxes showing up at our doorstep.
Right.
Albeit not now during the holidays. I feel like
right now is not the time to think about those Amazon boxes.
And broadly, people have been pulling back on spending on goods, and that's showing up. We're seeing real weakness in that part of the economy. But when you look at the service sector and specifically in all aspects of travel and tourism, hotel demand, airline demand, restaurant demand, all that is very strong. And we expect it, Oxford expects that to continue into 2023.
I think some of that has to do, I know I've talked about this before, but I think we have an experiential culture, right? Like if you think about the folks with the buying power, millennials, elder millennials, right? We value those experiences a little bit more than the Amazon boxes.
Yeah, and it's actually a trend that's played out over the past 2 decades as the sort of millennials have aged.
Yes, and gained a little bit more buying power in the process.
We also see that with Gen X and even with Gen Z now just beginning to flex their spending power. And we obviously saw a reversion of that during COVID, but now it's sort of pushing back, and I expect that we're could even accelerate that trend over the next few years. And that's one of the ways where I'm long-term very bullish on travel, on lodging, and specifically short-term rentals, because I think it's really the fastest growing aspect of our sector.
Yeah, I love that. That's such a good point. So that talks a lot about demand, which is sort of where we're getting the nice tailwind to combat the headwinds we're getting from a couple of other places. I think the housing is always a key critical component of a recession,
Yep.
right? Usually a leading indicator. Um, and also very big for supply. So let's talk a little bit about how supply may or may not match demand, if there's any sort of bright spots there for folks, or just things they should know about.
Yeah, I think I good things, good thing for operators, maybe not so good for investors.
Yeah,
We do expect supply growth to slow. Uh,
right.
so if we didn't see all the weakness in the housing market, rising interest rates, and our supply forecast would be significantly higher,
Got
and
it.
that would more than likely mean even stronger or weaker
Right, I
occupancy
was
going
about to
forward
say,
and bigger
yeah,
declines in occupancy. With rising interest rates, that has made investments in the short-term rental sector and more expensive. The monthly premium that
barrier to
you'd pay,
entry much
yeah,
higher.
is much higher. And we've got a chart in the report where it looks at the average monthly revenues that and just a typical short-term rental is earning, and then comparing that to what would be the monthly mortgage cost for a new investment in that month.
Got it. Okay.
And
Okay.
then where we compare
Right.
essentially what the premium is that you could get in investing in a short-term rental
Talking about
in
my
that
favorite
period.
chart.
In
Don't
that
worry,
period.
guys. We'll put it up on the screen right
Yeah.
now.
But what you've seen is you go from premiums of about 80%, i.e. the revenue that you'd earn
Wow.
is
Yeah.
almost double what the cost of that revenue is. And that's gone down to about 10%. So and that indicates to me that new investment in the short-term rental industry should slow.
Yeah.
Anecdotally, I'm hearing a lot about that.
Right. People
Um,
maybe taking a little pause.
yeah, we are seeing new listing growth, at least in the U.S., slow pretty substantially. Um, we expect that to continue into 2023. We don't expect the Fed to continue to raise interest rates at the rates they were at the increases they were doing in 2022. We do expect that to slow down, but we don't expect them to start pulling back on interest rates in 2023. We
Right.
essentially expect them to pause them,
Okay. Take a pause.
take a
Maybe take
pause,
a break. Hopefully.
and that means that 30-year mortgage rates, though, are still going to be around 5-6%
Right.
throughout the year,
Yeah.
and that's going to make the interest costs associated with buying a new home and double
Different
what it
equation.
was, yeah,
Yeah.
what it was in 2021. There is the other part of the equation, though, of sort of existing second homeowners.
That's what I was just going to ask about.
Yeah,
Let's talk about operators or potential operators that are maybe sitting on an investment that actually could still have a high premium.
yeah, and with some weakness in the economy, with the revenue opportunity still very high for short-term rental operators, many markets still recovering, especially in large city, mid-sized city areas that maybe haven't seen the supply growth that some of our destination and rural areas
Right.
have. We're not yet seeing a decline in revenues. Maybe won't even see a
Yeah.
decline in revenues for those location types, and that's where maybe we could see people pulling existing inventory into the short-term rental sector. We could see maybe homeowners that are moving. They don't necessarily want to give up
Oh,
their home with that low
right.
3% mortgage,
Yeah.
so
No, I wouldn't.
they'll look yeah they'll look to rent it out either on a long-term lease or as a
Short term.
short-term rental.
Yeah. If they're looking at their market and digging into things in Market Minder and saying, wow, actually demand's really high, I think they could still get a decent return on short term rental for sure.
Yep.
I love that. Okay, loaded question for you because I think I think there's lots of opportunity for folks to still enter the market based on the assets they already have. Okay, if I'm Jimmy Lehman, I'm sitting there and I'm thinking, should I put some money in the stock market or should I maybe take some money and invest it into real estate?
Yeah.
I'm sure there's no easy answer. I'm just personally asking, guys. I'm
Yeah.
personally asking.
No easy answer. I'm not a financial
Yeah, this is
planner.
not financial advice.
I do
This
not
is
give
not
financial advice.
Yeah, good
Um,
disclaimer. Thank you for
yeah,
that.
but I do think there's going to be pockets of investment in the short-term rental sector, especially in areas that are seeing falling home values. So
Right.
in many areas throughout the country, the housing market is definitely got a bit overheated.
Yep.
We saw values increase substantially, bidding wars, 20, 30, 40 bids for a single home.
Yeah. Cash offers, waive the inspection, the whole nine.
Right. Yeah, and now that's and totally flipped on its head. We have homes going to market that are getting one or two offers, where you can get and potentially get seller financing, get seller to pay the closing costs. But because of that sort of weaker housing market, we are seeing fewer homes come to market and substantially fewer homes actually trading. And that sort of plays into the fact that sellers still have really high expectations for home values. Buyers have maybe a bit lower expectations of what they should be paying. And yeah, there's a bit disconnect between that. And that's probably going to persist for a bit.
It's going to take a while for people to come to terms with the reality of the new situation, maybe.
Yeah, and then once maybe sellers and realize that if we are in a recession, if they're maybe forced to sell, that we could see more price discovery, more transactions start to happening. And at that price discovery phase, that's when we start to find the deals. That's when, and we start saying, okay, prices are maybe 10, 20, maybe in some markets 30% below sort of what they peaked out at. And then you can use Rentalize or use MarketMinder to understand the revenue potential for those properties, and then begin to find deals. So I think I'm a buyer in 2023. Maybe not today, but starting to look for those deals, and finding it out. Stock market, who knows?
Yeah. We won't comment on the stock market, but it's a good balance these things out.
It's going to be volatile.
Diversity is the best, I hear.
Yeah.
Right? Like a little bit in the stock, maybe a little bit in real estate.
Yeah.
Diversify your assets. I love this. Well, I think that's a really interesting perspective on housing. We covered supply pretty well. What else should folks be sort of aware of going into 2023? I guess, where are you on the Oxford? Are you taking the baseline? Are you taking the middle road?
I'm not as pessimistic. And Oxford is
that's your
personality. Yeah. I'm probably just over 50% chance of recession next year.
Okay.
So
just tipping the scale a little bit more towards it.
Tipping the scale, but maybe wouldn't have a recession in my baseline scenario. I think the path to a soft landing is high. We've seen continued strength in the labor market. I think broadly over the past year, employers have had a hard time hiring. They were sort of ramping up hiring at the beginning of 2022, had really hard time finding people. And now that they found those people, they're going to be really reluctant to get rid of them unless there's really a deep recession. And they see their revenues, their profitability really pull back. So that's where I don't expect the unemployment rate to tick up substantially, that employers look to hold on. And broadly, employment and employment growth is one of the best indicators of future lodging demand. So if you have your job, more than likely you're going to be traveling. If you lose the job, that's when you start to come back.
Just fantasizing about your vacation the whole time. So yes, agreed. I love that. So for investors that have decent solid takeaways, right, which is just keep watching, see where there may be opportunities in specific markets where we start to see those housing prices go down. Everyone kind of comes back down to ground from the absolutely crazy year that 2022 was. I know we talked before about how I bought in 2022 for better or for worse, but again, it was high, but the interest rate was low. And there's still places where there's pockets of opportunity, probably based on just interest in traveling and supply and demand. For our host friends, how should they be thinking about optimizing their ADR what should they be doing? Thinking, okay, maybe I'm not gonna, maybe I'm gonna be a little bit more realistic
Mhm.
about how much revenue I'm going to make next year, but I still want to shore up as much as I can, shore up those investments, make sure they're still yielding a return. What advice do you have for them?
Yeah, and that gets into sort of revenue management, and
100%.
and
Big topic.
big topic.
Big topic.
I'm
You have 2 minutes.
right. I'm I'm broadly, like, you can't be resting on your laurels. You got to be monitoring on a day-to-day basis. If sort of looking at your booking curve, looking at what amount of bookings you were getting last year, maybe at the same time,
Okay.
this year at the same time. If you're not getting the bookings you would expect or what you've seen in prior years, and it may be the time to start lowering prices,
Yeah.
even I'm slowly, like $5 at a time, see what
Okay.
that threshold might
Don't
be.
just go 50% off all of a sudden. It's not a fire
Yeah,
sale.
uh, to start getting bookings, I would really understand your seasonality. So
Okay.
if you're in a market like Denver in the winter,
Yeah.
and
Things
or a
shift a
market
little
like
quicker.
West Palm Beach in the winter, you're going to
Great place to
see
be in the winter.
entirely different seasonality.
Okay.
So understanding that, okay, maybe, and it's not my pricing, it's
Right.
just that it's off season, and if I do want to get occupancy, I might have to and really discount versus what I was charging early in the summer. We do not suggest that people have a flat rate throughout the entire year.
No,
You've got
we do
to
not suggest
adjust,
that.
and
Yeah,
you've
it's
got
not a
to
set it and forget
all right, you've got to adjust and throughout the year on a day-to-day basis as sort of demand plays out. Uh, and we've got lots of tools to sort of help people monitor their market book activity, their comp set activity, how that compares to what they're getting at their own property, so that they can go in and really manage rates effectively and make sure that they're getting their fair share of bookings that are happening in that market.
I
And
love that. I was just about to say, I think CopSnet is such an underutilized tool that we have because, like, yeah, I have a friend. She just decided to drop her price. Like, she's like, I'm dropping the price, and I was like, then have you looked to see what is happening with other folks in your neighborhood?
yep,
And then, yeah, that seasonality is so huge. And I think also just like not, looking at your revenue management maybe throughout the whole year, like taking a look at the next 12 months, where's seasonality, where do you expect to be, and then like, obviously pulling levers more
right.
often.
And that's what we're still seeing positive booking trends. So
Right.
I'm looking at over the next 3 months, demand's about 10% higher than it was during the same 3 months in the prior year. Though supply's up a bit more than that. So we are seeing um, bookings sort of per listing down about 6%. You look at some of the high markets, high supply growth markets that may be down 10, 15%. So that's on average, and a typical host is seeing 10 or 15% fewer bookings than they were seeing in the prior years. So that,
Okay.
and in some areas, some markets is concerning. And when you're in that environment of higher competition, and that is when prices usually start to soften a bit.
Gotcha. All really good advice, Jamie Lane. I'm so excited for everyone to get an opportunity to read your full report. Lots of great data in there. Um, and yeah, again, guys, get a reminder, check out your comp set. Don't, obviously be complacent in this time. Not a time to give up. Not
Yep.
a time to be cautiously optimistic and also very realistic about what could happen. It's a great time to look at the data, to look at the numbers, to start to plan out your year in advance. Hopefully understanding a little bit more what's happening on the macro level as well from Jamie's report.
Awesome.
Awesome.
And if you have comments, please share them.
Yes.
Uh,
We need feedback. We love it.
I'm on LinkedIn and Twitter. Would love to sort of hear and what's going on in your properties,
Yes.
and what is your forward bookings look like. Are you seeing significant weakness or not? And love to help everyone and better utilize MarketMinder for managing their rates. And if you need help with that, we're here.
Absolutely.
We like to think of ourselves as sort of champions behind data in the
Yes.
industry, and helping everyone out there better utilize the data that is out there to better run their business, and make sure that they're maximizing their revenues and successful in the long term.
Exactly. Yeah, we're all about making sure that everyone can be as successful as possible, and enabled as possible through the data. And yeah, Jamie's, you're actually insanely easy to get a hold of, you know. So yeah, but beyond Jamie, we also have our help team. Happy to help. So yes, we are just a tweet, a phone call, a ping away, a smoke signal, a carrier pigeon, all of those. We accept them all, you guys. Well, happy holidays to everyone, and thank you so much for listening to the STR Data Lab.
Thank
Until
you.
next time.
Happy holidays.
Bye, gang.